Welcome back. More signs of that 7+% mortgage rate pressuring housing today. Purchase applications for the week ending May 10th dropped 2% from the week prior, while refi demand was up just 5%. Meanwhile, homebuilder sentiment dropped in April for the first decline since November to be at the lowest level really since January. But falling yields are giving the builders a boost today. The ITB is at more than 2%. Toll is one of the best performers after Wells Fargo hiked its price target by $8 to $150 a share, saying there's potential for an earnings beat, upward guidance revisions, and positive long-term commentary in its report next Tuesday. Joining me now to discuss what's next for housing is Matt Graham. He's Chief Operating Officer at Mortgage News Daily. And Matt, as we just heard as well, Joe Terranova said he thinks Lennar is trying to break out to new highs. Our guest yesterday, Ari Wald, said he thought that housing could continue its leadership for potentially a couple of more years, at least in terms of the home builders. Could this status quo remain the status quo for quite some time?
It's hard to say when it comes to home building. I'm more of a rates guy. So I think that if we do get some relief in rates, it will help both sides of the spectrum, purchases and refinances.
What do you consider relief? A 10 basis point drop, or does it have to be something a lot more significant?
I think true relief would be a little bit more significant, something like a 1% drop. I mean, we've seen more than 10 basis points just today after the CPI data.
I think as long as we get below 7% at this point, people feel like it's not the worst thing.
Yeah, people have definitely acclimated to this new rate range. When we first got up into this range, it was kind of a shock and it really shut off volume very quickly. And now people understand that rates are higher and people that need to buy are buying.
I like how you said more broadly, we've seen this before, people starting to celebrate, hey, mortgage rates are going down. We've seen 3 false starts really in that direction already. And do you think this could be another?
It's sort of in progress, right? Because it depends how you want to define a false start. If we want to define it as early 2024 with rates moving back up after a really nice improvement at the end of 2023, yes, it's a false start. But there's a case to be made that you want to set a line with the previous high, and you only say, well, it was a false start if rates break back above that previous high, which they haven't done yet. And I really think there's a chance anyway that late 2023's highs, October, specifically, could be sort of a high watermark that was driven by a little bit of excess defensiveness and fear. Of course, all that's predicated on the fact that, or on the hope that inflation, core inflation, stays below a monthly rate of 0.3, 0.2. And in that case, we've definitely seen the highs in late 2023.
Although it seems, I guess, the larger takeaway from the last couple of years is that as long as rates remain where they are and without some big demographic change, people are going to kind of stay put in their existing homes, and that leaves the home builders to pick up the slack. You know what I mean? I don't think even, like you said, it would take a big move directionally one way or the other to really break us out of that long-term trend.
Yeah, absolutely. Home builders and the purchase side of the market's really been the only game in town with rates where they are right now. And there's been increasing predisposition for people with super low rates to hold on to those homes, even if they move and then become sort of de facto landlords. So all of that puts constraints on inventory and pushes the ball even further back in home builders' courts.
As election season heats up, I wouldn't be surprised to hear more talk about ways to make housing more affordable or bring the cost down or such. Are there players in the background who could, deal with mortgage debt, those kinds of things? Are you hearing anything like that? Is the market gearing up for anything like that?
There are a few sort of, I would say they're going to be inconsequential things floating around. I don't really know what to expect when it comes to the recent suggestion that Freddie Mac be able to buy home equity lines of credit. There have been some criticisms of upfront mortgage costs from the CFPB, which is interesting because in a roundabout way, the government is also driving some of the things that create those upfront costs through loan level price adjustments. And, it's really hard to immediately and quickly alter the cost of financing a home with government initiatives unless that initiative is somehow guaranteeing a lower interest rate.
Right. That leaves us then with just the two kind of adjustments or two levers to pull, which is the price overall and then, the cost of borrowing in order to fund that. So if you look out into the playbook for the fall or as the market starts to think about whether the Fed is going to cut in September or maybe December, as we just heard, how do you think that's going to affect mortgage rates?
Yeah, I think that mortgage rates will lead the way if they sense that the economic data is going to give the Fed the green light. And it's not just mortgage rates, but mortgage rates, treasury yields, other long-term debt that trades, moment to moment, as opposed to the Fed, who only meets 8 times a year. Market does a good job of getting ahead of that, and we'll see long-term rates move lower, even though the Fed is moving the shortest term rate.
All right, we'll see just how much lower and how much that changes the dynamic. For now, Matt, thanks. We appreciate your time today.
Thank you.
Matt Graham with